So who is going to start?
Yes, sir. Can you hear me?
Yeah, I can hear.
Yeah, okay. So, good afternoon. We're Group 2, and today we'll present our valuation assignment on the healthcare sector. Next slide. Yeah, so this is a brief of what we'll be looking at, and I'll be taking up the summary and the market share.
Okay,
Next.
just so there are 7 parts to it: summary, market share, growth outlook, cost structure. Okay, EV upon average revenue per operating bed. Then we have the sixth, the healthcare industry and comparative analysis. Okay, go ahead, please.
Okay. So, looking at the sector summary, we can see that the Indian healthcare sector is growing steadily. This growth is driven by rising demand, aging population, and higher healthcare awareness, as well as changing lifestyles. Pharma and medical devices dominate revenues, while biotech offers a high growth but high risk trade-off. And hospitals are expanding rapidly with digital adoption such as telemedicine, AI, digital reports, etc. So overall, this sector is resilient and it has a strong long-term outlook, which is one of the reasons why we chose this sector. So now, moving on to the trends, major trends of no, no, yeah, moving on to the major trends of the healthcare industry. The hospital services are expanding quickly due to rising patient inflow and private investments. And we can also see that India is emerging as a hub for medical tourism, mainly due to its high quality but yet affordable healthcare. And digital healthcare adoption is also accelerating, like I mentioned. Telemedicine and digital records are becoming standardized. Insurance penetration is also increasing, so which gives the consumers an affordability and accessibility option. And we can also observe that there's a higher demand for specialized care in fields such as cardiology or oncology, which pushes hospitals to invest in advanced technologies and infrastructure. Now, looking at the challenges, we can see that despite positive trends, there's also a few challenges, especially an infrastructure gap and out-of-pocket expenses, which are primarily have to be borne by the families who still bear most of the healthcare cost. And also, we can see that service quality and regulation vary widely, which can lead to trust issues among the consumers. There's also a workforce shortage, which can be noted in the rural areas, and that which continues to be a problem. And finally, hospitals also face financial pressure from rising cost, large capex needs, and regulatory uncertainty. Yeah, moving on. So our valuation will focus on primarily 5 healthcare companies: Apollo Hospitals, Max Healthcare, Fortis Healthcare, Narayana, and Global Health Limited. These hospitals cover 40% of India's organized hospital markets, and they span from multi-speciality to niche care. Next slide. So now we'll look at the market share and summary of all of these 5 companies. So the market share percentage has been calculated within the 5 companies, and we can see that Apollo Hospitals and Max Healthcare together contribute around 60% of the market share. Fortis Healthcare follows by close to 20%, and Narayana and Global Health have around 10% each. And now, when we look at the product and service mix offered by these different companies, we can see that hospitals such as Apollo, Max, Global Health, they look at multi-speciality offerings, and most of these hospitals, except I think Narayana, has diagnostics also, which they also offer. Narayana is specialized in cardiac and specialty care, and Fortis also has daycare centers. So this is the different product and service mix of of the hospitals. If we look at the key geographies served by each of them, yeah, we can see that Apollo Hospital is pan India and it also contributes a lot to medical tourism. Whereas companies like Max and Narayana are focused on one area. Like for example, Max is Delhi NCR, whereas Narayana is South India focused. Yeah, you can go on next slide.
Which companies, this has the South India focus?
Narayana, sir, South India, so
But they
especially
have an
Karnataka.
office, this thing in Gurgaon also, I think. So they have some presence in North also, is it?
Yeah, so they're expanding to pan India, which I've also mentioned, but primarily they're like South India focused, but they're
Okay,
also expanding.
okay.
Yeah, next slide.
So I'll be talking about the growth outlook. So right now the hospital market is valued at about 200 billion US dollars, and it's projected to almost double by to 450 billion by 2032. The overall healthcare market was just 110 billion back in 2016 and is expected to climb all the way to nearly 640 billion dollars by the end of 2025. That's a massive expansion in less than a decade. Now, such growth isn't just about revenues, it also translates into jobs. The sector already employs close to 7.5 billion people, and because of rising demand and shortages of skilled staff, that number is expected to almost double by 2030. But the challenge here is that the shortages are real, especially when it comes to doctors and nurses. On the government side, we are seeing strong support. In the union budget of 2025-26, allocations for healthcare went up to almost 100,000 crore rupees. That's roughly 11.5 billion US dollars, a healthy 10% increase from last year. And beyond direct spending, the government also announced a 50,000 crore credit incentive program to help strengthen healthcare infrastructure. Telemedicine is also on track to cross $5.4 billion by 2025. But it's not all smooth sailing. India's public health expenditure is still under 2% of GDP, which is well below the global average. The doctor to patient ratio is still stretched, about 1 to 1500 in many regions, and rural access continues to lag far behind urban centers. Next slide. Now, let's look at some of the leading players in the private healthcare space which we have chosen for valuation. Starting with Apollo Hospitals, this is the pioneer of corporate healthcare in India. Apollo has been growing at around 14 to 15% annual growth rate over the past decade, and in financial year 2025, their profits shot up by more than 40%. They're not slowing down. Over the next 3 to 4 years, they're adding more than 4,000 new beds, scaling up their digital health platform, and even investing in advanced facilities like proton therapy in Gurgaon. Growth is expected from higher occupancy rates, medical tourism, and supportive policies. That said, high capital costs and regulatory hurdles remain the real risks, especially given the scale of their ambitions. Moving to Max Healthcare, this company has been the standout performer recently. In financial year 2024 alone, revenues jumped to almost 30%, and profits have grown at an incredible 64% annual growth rate over the last 5 years. Their plan is to nearly double capacity to 9,500 beds by 2028, with major new hospitals coming up in Lucknow and Nagpur. The risks mainly are ensuring all this new capacity is fully utilized, facing intense competition, and managing rising staffing costs. Then there's Fortis Healthcare. Fortis had a steady run with net profits growing at about 40% annual growth rate over 9 straight quarters. In quarter one of financial year 2025, their revenue was up by 8%, while EBITDA grew by more than 28%. Their strategy is to expand through acquisitions of mid-sized hospitals, add greenfield and brownfield projects, and strengthen diagnostics, possibly through rebranding. But again, the capital intensive nature of this growth and regulatory uncertainty could weigh them down. Next slide. Next, let's talk about Narayana Health. What makes Narayana unique is its focus on affordable care. Over the past 5 years, the revenue has doubled. Profits have grown at a CAGR of more than 40%, while sales rose at around 12% CAGR. On the expansion side, it is spreading both within India and globally. They have invested in the Cayman Islands while also setting up new hospitals and cardiac centers in underserved Indian regions. But challenges like keeping margins intact if utilization is low or balancing affordability with the high cost of advanced medical technology still remain. Finally, coming to Global Health Limited, it is on a very ambitious expansion drive with a capex plan of 4,000 crore rupees
So
to
Narayana
nearly
Health is
double.
having, they have an international presence also. Cayman Islands,
Yes, sir.
is it?
Cayman Islands.
Okay, okay. Good.
So, Global Health Limited is on an expansion drive with a capex plan of 4,000 crore rupees to nearly double capacity from 3,000 to 6,000 beds. They're building new hospitals in Noida, Guwahati, Mumbai, and Delhi. Uh, their revenue rose by 15% in the last quarter of financial year 2024. Their profits slipped nearly by 20% because of rising costs. So, here the real test will be execution. So, when we look at these five companies together, we see both the promise and the pressure points of the Indian healthcare industry. So, all in all, India's healthcare sector has immense potential, but execution will decide who wins.
In this section, we'll be looking at the operational cost drivers
So
for
ठीक
the
है. I
health.
mean, Ishani, you've done very well, both of you. I mean, Ishani as well as Ranjana. The parts were very good. Okay. Mahalakshmi.
Yes, sir. So in this section, I'll be covering about the operational cost drivers of the healthcare industry. To help frame this discussion, let's think of it like our monthly household budget. We have major expenses like rent or EMI, groceries, electricity, and let's say salaries for any driver or house help. And a hospital's budget works on the same principles, but let's see how that scales up. In the context of hospitals, our groceries become medical consumables and drugs for patients, and the salaries for a cook or driver become salaries for a team of highly skilled doctors, nurses, and other technicians. The monthly electricity and water bills become a massive 24/7 power, fuel, and utilities bill for life support system, AC, and sterilization, which needs to run round the clock. And the monthly home EMI or rental bills become the, and even appliance maintenance, let's say like fridge, TV, etc., become the facility and equipment cost, covering everything like right from the building to the multi-crore MRI machines we see. And the phone and Wi-Fi bills become part of the administrative overheads.
So
And let's say,
44% is basically the staff expenses.
yes, sir, I'll be explaining each
Yeah, sure, sure.
component.
Please go ahead.
So, and for example, if you were to advertise your mom's home business, that would be like the hospital's marketing cost.
Hmm.
So, if we look at the overall scale, to run a single hospital in India, it can cost anywhere from 18 crore to a staggering 91 crore rupees. And to standardize this, we often look at the cost per bed because this helps us compare. We can't compare apples to oranges, for example, like because a small 50-bed hospital in a tier 2 city is very different from how a 500-bed multi specialty chain in a metro operates. So, we're looking at the cost per bed over here. And if we see the single largest chunk of a hospital's budget, making up almost 44% of the total cost, goes to its people. It's because healthcare is a human capital intensive industry. And this includes the salaries, benefits, and training for the surgeons, the critical care nurses, to lab technicians, and everyone. And since this requires level of skills, it also commands a high cost, making it the most significant investment a hospital can make. And the second largest component at 27% is the medical consumables and drugs. This is the direct cost for the patient care. This includes every glove, syringe, medicine, stent, and implants. So, this can also vary dramatically based on the hospital specialization, because let's say a cardiac hospital using high end stents will have a much higher cost per bed than a general hospital. Next slide. In this combining like facility and equipment, accounting for 18% of the cost. This includes depreciation for high value equipment like CT scanners and other surgery equipment, which will lose value over its time. So this cost is spread out over its lifespan. And rent is applicable on leased properties because not everything may be owned by the hospital directly. And maintenance is very critical, and regular maintenance of all the sophisticated equipment is a non-negotiable factor for patient safety. And the rest 11% is split between essential operational costs like power, fuel, and utilities, because the lights, AC, oxygen supply needs to be there all the time for a hospital to run efficiently. And administrative overheads is like the backbone of the organization, which includes IT systems for patient records, like the ones we see in ICU, for monitoring them 24 by 7, and also insurance claim processing, other salaries, and legal compliance systems. The last part is selling, marketing, and distribution. This is especially for private hospitals. This includes advertising, ambulance services, and even community outreach programs to attract patients. Next slide. So this slide shows a comparison of. I've explained each cost driver in detail, and based on the scale. scale, the range which I've mentioned can vary based on the location, whether it's in a metro or in a different
Can
tier
you
two
just make it
city.
little bit, bolder? I mean, I can't see it. So, yeah.
So
Okay,
this
now I
is
can
just
see.
like
It's okay.
telling.
It's okay. I know.
So
I'll just go through the slide. Okay, fine. But I was finding it bit. Okay. So this is basically the cost driver
yes, sir.
and
So
the
each component I've mentioned like a realistic range. So
okay.
the lower limit and upper limit basically tells us how it can vary from, let's say, like a tier two city hospital to a large scale. In these list of companies, Apollo would be like the most, let's say, like luxurious
Yeah.
hospital or something. So that would be on the upper side. This is
Okay.
like just to give like a comparison.
Okay. Great. Go ahead.
Next slide. Coming to the EV by average revenue per occupied bed calculation, for this I would like to take the example. Let's say, unlike in the scenario in a manufacturing industry, let's say I have a plant and I can produce 5,000 units in a 10-hour shift. I can decide to, run it twice a day and produce 10,000 units a day, but that's not how a hospital works. I may have 100 beds, but I may not have 100 patients visiting my hospital every day. So this is why we gauge the true efficiency by the occupancy rate of the hospitals. So this table shows the total number of beds and the occupancy rate. All these data are sourced from the annual reports of the companies. And with this, we calculate the average revenue per occupied bed per day. And why are we using this metric is because different hospitals have different specialities and they're located in different geographies and have different pricing power. So the average revenue per occupied bed normalizes these financial performance across the differences, making cross company comparison a more fair in a more fair way.
So which is the
And
most costliest hospital in terms of average
sir,
revenue?
so actually, when I was doing this, I was surprised to see Max Healthcare having a higher EV by average revenue per occupied bed.
So why
But
you are
that's also,
surprised?
sir, it's because I thought Apollo will have the highest value, given they have more capacity, they have more sales, and they had a higher EV value also. But it also depends on the geography again and the cost. I mean, the average revenue per occupied bed which they're making. So if we see that, it's higher for Max Healthcare. And this is how it varies between the five different companies also. Even if it has a lesser capacity, when it has a higher occupancy rate, it directly influences the EV by average revenue per
Again,
occupied bed.
it all depends again, how, like, for example, Narayana,
Hmm.
has the lowest, like
Yeah.
48,000 revenue per occupied land, this thing. Again, because the doctors, like specialist doctors and all, their charges are very high. Okay, so
Yes, sir.
I mean, all is recovered through basically through the revenue. Okay, like consultancy charges and all or bed charges, all are part of this revenue. Okay, so it all, I mean, like like Fortes, I mean, Max and Apollo, or maybe Max is hiring the best of the talent. Maybe they are
Yes,
paying the
sir.
maximum to the doctors. Okay, whereas Narayana is doing with with the low end doctors. Okay,
That's why even in the previous slide I had mentioned, like, let's say Apollo hospitals, when we go there, they have, let's say, a higher focus on infra also,
yeah,
whereas Narayana would have like a minimalistic
on the infra.
design, and the quality of care is what is basically the differentiating factor in a healthcare
Yeah, yeah.
industry. That's what builds the reputation of a company, and that's probably why there are inherent differences
So
in all.
one more thing, Mahalakshmi, what we were, looking at about a year back when I was analyzing this. So
Hmm.
we found Narayana was, had a very good reputation because they were not
Yes.
charging so much from the patients, and providing a very good healthcare. Whereas, Max Healthcare, their main motto was to make money. Okay,
Hmm.
and people are not very happy with the reputation being charged so heavily, but the patients are not getting cured. So Narayana had made a name, okay, that it is least costliest of the all the hospitals and providing a very good healthcare. So this was coming quite evident from this average revenue per occupied bed per day kind of for this thing. Okay. So that was
Yes.
my take that time that Narayana is equally good among all the hospital, and the if you somebody is admitted, he will be charged very less compared to all other hospitals. Okay, so
Yes,
that was
I agree with that, and that's also why it's probably only the numbers are relevant only because of the capacity and the occupancy rate
yeah,
listed in relation with the average revenue.
sure.
And also a similar comparison would be Shankar Netralaya. Even that's very that's predominantly famous in the south. It's a not-for-profit organization primarily
Okay.
for eye care, and even there there's a huge boom in medical tourism. There are a lot of patients who come from north and eastern India to the south for Shankar Netralaya itself,
Mm-hmm.
and even
So
like
what is that
cancer.
hospital name?
Shankar Netralaya.
Shankar Netralaya. Okay, okay. This is in South, isn't it?
Yes, sir.
But how come, it has a pure Hindi name, Netralaya? I mean, which is a Hindi word, I believe. I mean, in South
Yes, sir.
also you call it
Like,
Netralaya?
I mean, I think it's like a Sanskrit and Tamil term, netra for eyes.
Okay,
So
okay, okay. So that means it's a common for both Hindi and Tamil. We call it
yeah.
Netralaya. Okay, okay. Fine.
And okay, next slide. So this line chart just shows the EBITDA margin comparison of how uh, different companies have the different growth trajectories. The workings for this are linked from the Excel, and if we see the Apollo's EBITDA margin has been volatile, and it has a peak in FY 2022, and before dipping, and then this probably shows a steady recovery over the last 2 years, and this could probably be because of the post-pandemic surge
Hmm.
in the number of surgeries and higher revenue from their diagnostics and telehealth services,
So
which
are in
probably.
Mahalakshmi, your main is finance or the economics?
Sir, I'm a management studies major and I'm pursuing a minor in economics.
Okay. And this is your final year?
Yes, sir.
Okay, good. So, but this is the first course you are studying under me? I mean, is it? So you have not studied
Yes.
any of the course which I have carried out in the last.
Yes, sir. I've done other FAC electives, but this is the first time I'm taking a course under you.
Okay, okay, good. Go ahead, please.
Yeah, so this chart in general just shows the trends for each of the company we've chosen, and Max demonstrated the most impressive and consistent margin performance. Like if you can touch on each year, we'll be able to see the numbers and how there are different growth stages for each of the
So
companies.
which hospital has the maximum EBITDA margin?
So right now it was for Max Healthcare.
Okay, but this is not coming very evidently from your slide, because unless we have to go through your slide carefully and browse
Yes,
through.
sir.
But
So the
a
line chart.
histogram or a bar chart would have been always a better for each this thing. But anyway, okay. So
Yeah.
which is the lowest one? The last one,
Lowest one was actually Apollo.
Apollo. Okay, so EBITDA margin, in terms of EBITDA margin, the lowest is Apollo, and in
Yeah.
terms of highest EBITDA margin, highest it is what? Fortis
Highest EBITDA margin is for Max.
max. Okay, ठीक है चलो. Okay, go
Yeah.
ahead.
Next slide.
So what does this slide actually mean to you? Why are you presenting it?
So it's because, like how we saw, there are both operational metrics and qualitative factors which we take into consideration when we are like valuing a company.
Hmm.
We've seen how the operational part was, and there are more quantitative measures which Mananya will be explaining in the next slide. But this also reveals how efficiently is the company able to, um, use its assets, and we're comparing the earnings to the overall sales made by the company over
Yeah,
here.
actually, this is the cash profit the company is earning. Okay, and this is a cash profit margin. Okay,
Yeah.
fine. Now, all the hospitals, particularly, because each one of the hospital has different margins, and they, as you have seen that, they keep fluctuating. Okay, every year, a little bit here and there. So, and it becomes a very important parameter, any company would like to, have a benchmark company, like suppose a company which is the best in the industry would be having a EBITDA margin of say 30% or 25% or 15%. Okay. And your margin is say 10%. So you like to bridge the gap. Okay. And try to find out, why your margins are less compared to the best in the industry. Because you're also, in the same industry, you're selling the same product, same service, and you're less profitable compared to the others. So this becomes a very important parameter for managing your businesses and understanding, where you're going wrong, where you're going right. Okay.
Yes, sir.
So it is telling you how much money you're making, as a margin. Okay. Like you're selling your product, somebody is making 20% margin, another is making 15%, another maybe making just 5%. So the person who's making 5% would like to improve upon to, at least go to 10 to 12%. Okay, so that is the idea basically. Okay,
Yes.
Right. So
okay,
I'll
Mananya.
now be, yes, sir.
Mananya.
Am I audible?
Yeah, I'm on. You're audible.
Yes. So I'll now be presenting our valuation analysis of the Indian healthcare delivery sector.
इसको थोड़ा बड़ा
So,
कर लो,
yes.
if you can. Yeah.
Yeah. Is it better now?
हाँ ठीक है चलो और फिर सो के I'm just listening now. Okay, don't worry
Okay.
about, don't make it. So I'm not looking at the chart. I'm
Right.
just hearing out what you're saying. Okay.
Okay. Right, sir. So the objective was to compare their financials, the growth outlook, their relative valuations, and a little bit of technical analysis as well to arrive at an informed investment recommendation at the end of this valuation exercise. So, as of 17 September 2025, Apollo and Max they dominate the landscape in terms of market cap, each valued at around rupees
Which one?
1.12
Apollo and
max.
Max. Okay.
Yes. So each is valued at around rupees 1.12 lakh crores in market cap.
And how much is
Fortis,
Fortis? How much is Fortis?
Fortis stands at nearly 73,000 crore,
Okay.
while Narayana and Global Health, they are much smaller, clustered around 35,000 crores.
Okay.
In terms of scale, Apollo is in a league of its own, generating revenues of over 22,500 crores, almost three times larger than the next player, which
Okay.
is Fortis. What's impressive is that this scale for Apollo, it also translates into earnings power. As we can see, Apollo delivers close to rupees 3,500 crores in EBITDA, which again is well ahead of its peers.
Hmm.
Fortis, despite being smaller, has healthy profitability, rupees 1,740 crores EBITDA. Same goes for Max and Narayana and Global Health. They operate at slightly thinner margins. Moving on to valuations, they tell a more deeper and a more nuanced story. On average, as we can see, the sector trades at about 68 times earnings and 40 times EV to EBITDA, signaling that the market is already pricing in aggressive growth for this particular sector.
Okay, again
Apollo,
to Mananya,
yes, sir.
healthcare has been doing very well in the last couple of years. So you'll find, they
Yes,
have all have elevated, P multiples. So that means, a lot of people have showing interest in investing in these stocks and they're making huge amount of money because there's a good growth story associated with these companies. So what is the average growth which is taking place in this industry? I mean, have you made the growth part also somewhere? Yeah,
yes, sir. So the average EPS growth is around 27%,
this is phenomenal.
which yes, which again is, I mean, we were considering other industries as well, IT, FMCG, but healthcare stood out to be performing the best actually relatively because it is advancing so well. And there's a lot of chatter about the healthcare industry, which is
Yeah.
visible in terms of be it the price or the multiples, etc.
Yeah, like suppose I don't know. I mean, many of us, go to the hospitals. Somebody's admitted or so, go for some checkup. Of course, we never want to go to a hospital. I mean, we're not happy to go to there. But whenever we go, we find lots of this thing. It's very difficult to park your car there, and they are all very overcrowded. Whether they are very expensive, whether they are cheap, you will find there's a lot of waiting time. To meet the doctor, and there's a huge rush. In all hospitals. So the hospital industries, are doing a lot of business, and they're growing
Right.
at a very blistering pace. So that is what you said, okay?
Yes, sir. So can I continue with the
Sure,
valuations?
sure, sure, sure. But one more thing, the odd thing about
Right.
these hospitals is that, people are not satisfied. They all feel that they are overcharging. The patients are not getting cured so well, but they have to
Mhm.
pay very huge money. Most of us are all insured. So the hospitals, they charge lots of money. And because it's not paid by the patient, it's been reimbursed by the healthcare policies. Of course, the healthcare policy needs to be, again,
Right.
taken up by the family and all. So it's cost basically, but they don't have a very good reputation. Okay.
Mhm.
Particularly the hospitals and doctors nowadays, whom we used to treat them like gods, but now it is, people have the reverse view that,
Yeah.
people should not let up in a hospital. Okay, fine.
Right. So, but again, I think our hands are tied at the end of the day because we do need doctors to survive.
Yeah,
And
yeah,
of course, there is a rising demand for quality care. There is a deeper
yeah.
insurance penetration,
So
as you said.
just to tell you, I worked for 5 years in a hospital. Okay.
Okay.
So
Yes,
I
sir.
know almost like 500 doctors. I'm filing the income tax return in Delhi and Gurgaon. So
Right.
I know their, how much money they are making, basically crores of rupees. Okay. Anyway, so
Mhm. Right. So, Apollo and Fortis, as we can see, they stand out as relatively cheaper. Apollo trades at close to average earnings and below average EV to EBITDA, while Fortis is in a similar range. Max Healthcare is the clear outlier at 93 times PE and 55 times EV to EBITDA. Global Healthcare is also trading pretty rich at 57 times the PE. Sorry, at 61 times the PE. Dividend yields across the board are, however, negligible, under 0.515% on average, which underlines the fact that these companies they are reinvesting their capital into growth rather than rewarding the shareholders today.
no,
So,
but
in
again,
valuation,
dividend yield basically is, a function of the dividend and the market price. The share market price has gone so high that,
Mhm.
the dividend yield becomes, like sub 0.5%. Okay, fine.
Right.
So they are giving dividend. Okay, of course, they're redeploying their money back into the business. But
Mhm.
since the share, I mean, they're trading at a, almost at a very lofty valuations of 60 times or 70 times their earning. So the dividend yield will always drop because of that. Okay.
Yes,
But
sir. That.
एक बात बताओ मुन्ने, I mean, the way you're presenting and, I mean, talking about, as if you have a good knowledge about, what you're saying. But आप क्लास में तो ज़्यादा आते ही नहीं हो.
सर आती तो हूँ.
हाँ, आते तो हो, जल्दी चुपचाप बैठे होते हो. But last year you were still, I could hear you a lot. But this time, this is your final year.
Yes, sir. It's my
Okay.
final year.
So final year generally, the interaction drops because of,
Attendance.
whatever may be the reason. So, ठीक है, but you have done very well. Your presentation is very well, and your group, I believe, is in today's, this thing, it is the best. Okay.
Thank you, sir. Sir, I'll definitely interact more in classes, sir.
It's
Sir,
okay. I'm okay, but I just, because I was hearing you a lot in the last semester as compared to,
yes.
yeah, most of the time, maybe that you're attending only the online classes, physical classes, so you're always missing. Of course, last year also, I mean, you were not coming so much, but still your attendance was better compared to, I mean, this semester. Your
Yes.
attendance means interaction in the class was better last time. Okay.
Yes, sir.
But have you
Uh,
understood, this subject basically well this semester?
Definitely, sir. In fact, I had done a similar course on valuation before,
Okay.
and I have a very deep interest in financial research. So,
Okay.
this helped me learn more about the sector, more about valuation. In fact, after this, we'll be moving on to technical analysis as well, which I remember you had mentioned in class. So, I
Yeah.
thought we'd include a mix of both fundamental and technical analysis so that
Yeah.
we can get a more complete picture
Yeah.
when
Sure.
we are giving actual recommendations.
Okay.
So turning to the technical picture,
Yeah.
right? So which we consider alongside the fundamentals.
Here, a golden crossover, as I remember you had mentioned in class, where the 50-day moving average is above the 200-day moving average, with the
Yeah.
price being above both. It is a classic bullish confirmation.
Okay.
So, in our sheets, from what we could find on this is from these screenshots are from Screener.
Yeah.
So, Apollo and Fortis they display the golden crossover, and with the price trading above both the DMAs, which
Okay.
is a strong bullish signal.
For which
Their
hospital?
technique
For that, what two hospitals? Apollo and
Fortis.
Fortis. Okay.
Yes, sir. So, as you can see on the screen, we've also attached screenshots.
Okay, but I think that would be true for most of the hospitals. Like, they would be trading above their 50-day and 200-day moving average, isn't it? Or there's
Not really,
not all.
sir. But for Max, Narayana, and Global Health, they show a different setup with the price being above the 200-day average. So the long
Okay.
term trend is intact, but
Okay.
they are slightly below the 50-day average, as we can
So this
see,
is a very good
indicating.
slide which you have prepared, and you have shown a snapshot of all the, technical indicators, both the moving averages and the price chart. So there are how many hospitals? Just take me through. I mean, there are three on one chart. Yeah,
So there are
just
five,
five.
Apollo, Max, and Fortis again on the second slide. So
Okay.
there are five in total.
Okay, five in total.
So, right. So as we can see,
So
that
technical
means that.
analysis पहले आपने कहीं पढ़ा है? I mean, have you read for the first time or you done it in your course earlier?
So I remember you taught this in class actually, the one offline class that I had attended.
Yeah, yeah, I've taught, yeah.
There
I
you
know
had
I've
mentioned
taught it,
technical
but
analysis.
other than my class, have you even, it has been taught in any other semester anywhere?
Uh, no, sir. We've mostly stuck to fundamental analysis and valuation,
Okay,
but technical analysis I heard for the first time in your course, and I was actually very interested and intrigued by that, which is
okay.
why I went later and I read more about it, and I thought
Because
I'd
these are
include it
basically
in
the
this.
long-term charts, which is talking about 200-day and 50-day. In one of the
Right.
class, I tried to talk about like lower moving averages, like 10-day versus 20-day moving averages, which are basically used more in the future and options trade.
Right.
So because next semester I'm going to take a course for the MBA students of Shivnadar, which is basically we are going to talk about the derivatives there.
Okay.
So,
Okay.
ठीक है, चलो
That's
good. So this is a very good slide. I mean, you people have done very good, and this is the best presentation of the day.
Thank you. So we just left with a little bit more. So,
Okay, okay,
uh,
let's go.
yeah, moving on to our final investment recommendations. So, our investment stance blends fundamentals, valuations, and technical signals. Apollo, we've rated a buy. It has superior market leadership, EPS, CAGR, compelling valuation support in terms of PE ratios, EV EBITDA, the PEG ratio, and a confirmed golden crossover, which makes it the most attractive risk reward in this healthcare space. Fortis again is rated a buy, which is very similar to Apollo, with a robust EPS CAGR, great growing multiples, and bullish technical confirmation. Max has been rated a hold. The earnings trajectory is solid, but the excessive valuations and a near term consolidation phase beneath the 50-day moving average, it limits the upside capture. So we prefer to await either a valuation reset or stronger price confirmation. Narayana and Global Health, we've also rated hold. The structural themes remain intact, but muted earnings growth in case of Narayana and premium valuations in case of Global Health, coupled with short term technical weakness, warrant patience. So, to conclude, the Indian healthcare sector is thriving on structural tailwinds, like you mentioned, sir, rising demand for quality care, deeper insurance penetration, rapid urbanization, and post COVID acceleration in private healthcare capacities. So, our key learning from this exercise was that growth alone, in terms of price upside or earnings growth, is not enough. Valuations and technicals must also validate the story. That's precisely why Apollo and Fortis, with their superior EPS growth, attractive multiples, and bullish golden crossovers, stand out as our buys. We chose this sector because it reflects India's future readiness in healthcare, while also allowing us to apply a blend of fundamental valuation and technical frameworks to to separate sustainable long-term compounding value from just short-term market outperformance. And finally, just as doctors prescribe the right medicines after diagnosis, we too conclude with clear investment prescriptions. That is to overweight Apollo and Fortis and hold the rest, which is Global Health, Max, and Narayana, until the pulse evaluations and momentum improves. That's
Yeah.
it, sir.
Okay, very good, wonderful. I was just thinking when I gone for a break and we thought we'll start after 15 minutes. So I was just thinking, we will be concluding it fast, but it was not because the presentation was so good and I was enjoying it, and each one of you have done a very good job. Okay, and you have all got done very well. Of course, Mananya is finally, was an icing on a cake, basically. बहुत ही बढ़िया. I mean, Mananya, your part was also very good. And Mahalakshmi, Ishani, and other one was Mahalakshmi and Ranjana.
Ranjana, sir.
Ranjana, yeah. So all of you have done excellent. Okay, good. Chalo then, see you then. Okay, bye. Thank you
Okay.
so much.
Thank you so much,
Thank you,
sir.
sir.
Okay, bye.
Thank you, sir.
Okay.